Imagine a company that signs contracts worth 100 times more than its annual revenue. Not 2 times, not 10 times, 100 times. That's OpenAI right now, $13 billion in revenue, $1.4 trillion in infrastructure commitments. This is not a crash prediction. This is a math problem. The AI infrastructure race has reached a scale we've never seen before. In 2026 alone, hyperscalers are expected to spend over $600 billion in capital expenditures. Between 2025 and 2028, total global AI infrastructure investment could approach $3 trillion. And here's the shift. Nearly half of that is now financed through debt, not retained earnings, not organic growth debt. This is larger than the telecom bubble, larger than the dot-com infrastructure build-out, and far more leveraged. But here's where it gets uncomfortable. OpenAI has committed roughly $1.4 trillion in infrastructure contracts through 2033. Not projected, not hypothetical, contracted. About $250 billion to Microsoft. Over $300 billion to Oracle. Tens of billions more to AWS and chip suppliers, against $13 billion in annual revenue. That's a 108 times gap. No modern startup has ever operated at this ratio. Not Uber, not Amazon. This isn't just aggressive expansion, it's pre-spending the next decade. And this is where things start to get interesting. Nvidia isn't just selling chips. It's investing in its customers. It's financing special-purpose vehicles that buy its own hardware. It owns equity stakes in companies like CoreWeave. And in some cases, it subsidizes financing to make large GPU leases possible. For example, Nvidia invests in an AI startup. That startup uses the capital to rent cloud infrastructure. The cloud provider then spends billions buying Nvidia GPUs. The money moves in a circle. Roughly 67% of Nvidia's revenue exposure is tied to clients it helps fund. This is called vendor financing. Lucent Technologies did something similar during the dot-com era. That doesn't mean Nvidia collapses, but it does mean demand is partially self-funded. And when demand is financed by the supplier, the math changes. But here's the part markets are starting to price in. A large portion of this AI debt is backed by GPUs themselves, and GPUs are not real estate. They depreciate fast. The rental price of Nvidia's H100 chips has fallen roughly 65% in just 18 months. From around $8 per hour at the peaks, we're down to $2 or $3 today. Yet many loans assume a useful life of 6 years. In reality, cutting-edge chips often become economically obsolete in 2 to 4. If collateral values drop 20 to 30%, loan covenants can break. And when covenants break, lenders demand more capital. But the constraint isn't only financial. It's physical. In Northern Virginia, the largest data center hub in the world, new grid connections can take 3 to 5 years. In parts of the UK and Ireland, the wait stretches to 8 or even 10 years. In Dublin, new requests are effectively frozen until 2028. Data centers now consume roughly 22% of Ireland's entire electricity supply. Some lenders are financing power plants before the data centers themselves. Electricity has become more valuable than land. And AI doesn't run on code, it runs on power. Now here's the economic core of the issue. For every dollar spent on high-end GPUs, the industry needs roughly $4 in revenue just to break even, once you factor in data centers, cooling, and power. That's a 4-to-1 revenue requirement. Yet the entire generative AI software market generated around $50 to $60 billion last year. OpenAI revenue was about $13 billion. Investment is running nearly 100 times ahead of monetization. That gap doesn't have to mean collapse, but it does mean the clock is ticking. Now, before we call this a bubble, there's another side to the story. Hyperscalers aren't spending this money blindly. Much of this investment is defensive. If AI reshapes productivity, search, software, and automation, the companies that underinvest could lose everything. There's also the possibility of massive internal efficiency gains, trillions of dollars in labor savings over time. Inference costs have fallen nearly 280 times in just 2 years. And historically, railroads, electricity, and the internet all went through phases of overbuilding before becoming the backbone of the global economy. Overinvestment doesn't automatically mean failure. Sometimes it means acceleration. So what's the real risk here? It's not that AI disappears. It's that infrastructure returns don't match infrastructure spending. And when returns lag debt, Credit markets reprice. Oracle's credit default swaps have climbed to levels not seen since the financial crisis. AI-related sectors now make up roughly 18% of the U.S. investment-grade corporate bond index. This is no longer just a tech stock story. It's a credit market story. If AI revenue accelerates fast enough, this becomes the backbone of the next century. If it doesn't, we don't get an AI collapse. We get an AI deleveraging. And deleveraging is quieter, but it reshapes everything. Because in the end, revolutions don't fail because of ambition. They fail because of math.